afternoon. I'm Reena Agarwal, Vice Provost for Faculty at Georgetown University and the Director of our Georgetown Center for Financial Markets and Policy. Welcome to our Georgetown Global Virtual FinTech Seminar Series. This really is unprecedented times. I just hope everyone is safe and healthy. At the Center for Financial Markets and Policy, we provide thought leadership for global finance. We believe in excellence in research to impact practice and policy. Recently, we hosted an event with 5 former chief economists of the SEC and a former SEC commissioner examining the impact of the current crisis on our markets and functioning of our markets. That recording is available on our website. Please feel free to check it out. And I invite you to visit our website to learn more about the center and also follow our Twitter hashtag @GUFinPolicy. I want to start off by thanking Alberto Rossi. Professor Rossi is the Associate Director of the Center, and Anna Kormas, the Assistant Director of the Center, who have helped us to put this series together. I want to thank Ripple, Georgetown and the Center. We are part of the Ripple University Blockchain Research Initiative, and that initiative and that sponsorship helps us to run this seminar series. So our last few presenters have been Maureen O'Hara from Cornell and Manju Puri from Duke. Today we have Luigi Zingales, and I'll introduce Luigi in just a minute. Our other confirmed speakers, we have Antoinette Shore, David Yermak, Coast John. So those are Amit Seru. Those are some of our confirmed speakers as of now. So today we are absolutely delighted to have Professor Luigi Zingales as the presenter. Luigi is the Robert McCormack Distinguished Service Professor of Entrepreneurship and Finance at University of Chicago's Booth School. And before I turn it over to Luigi, I just want to point out a few logistics here. So this is a 1-hour seminar, and we'll keep about 15-20 minutes for Q&A. But Alberto is going to try and see if he can take questions as we go along instead of just waiting for the end. Also, please feel free to send us your questions via chat, and Alberto will try to use some of those questions, get those addressed. And do feel free to raise your hand using the Zoom feature for raising your hand, and we'll call upon you to ask your questions. And I request if you can keep yourself muted during the event, that would be great. Again, thanks so much for joining us. And with that, I'm going to pass it over to Luigi.
Thank you very much, Reena. And Alberto, please feel free to stop me if I go too fast. One of the problems with a virtual seminar is that you don't see the faces of people staring at you with a sort of a look like we are not understanding anything. And so you might overdo it. But I think it's only fitting that a seminar about FinTech is becoming virtual. If there is one silver lining of the current terrible pandemic, is that FinTech is going to become even more important after the pandemic, because during the pandemic, everything is becoming digital, everything is becoming virtual. And I think that that's very important. And the good news, in spite of the title, there are no deaths in my paper. So unfortunately, we talk about so many about death from the coronavirus. So there is no blood. And this is joint work with Krishna Kamepali and Raghu Rajan. And the motivation is very simple. You hear a lot of venture capitalists, this is one, Albert Wenger, claiming that there is a area in the industrial space where people don't invest anymore because they've been deterred by the fact that everybody who starts is acquired by Facebook and Google. And this idea has been important enough that Elizabeth Warren, when she was running for president, she actually cited this as one reason why the antitrust needs to intervene. So venture capitalists are now hesitant to fund new startups to compete with the big tech companies, because it's so easy for the big companies to either snap up growing competitors or drive them out of business. Now, clearly, driving out of business is a different story, but if you think about acquisition, this seems to fly in the face of standard economics. And in fact, when Elizabeth Warren stated this and she made her proposal, a lot of economists on Twitter made fun of her, like saying, how can it possibly be the case? Because after all, if I see WhatsApp being acquired at very hefty multiples, at very high valuation by Facebook, why don't I want to start something similar so that I can get the privilege? And so what we trying to figure out is the standard conclusion, and let's agree that in standard microeconomic textbook, this idea is clearly wrong. In a sense, it's clear that if I get acquired for very high valuation, that's an incentive to produce more of it, okay? And the question is it still true in a world that is the world we are currently living more and more in, particularly during this pandemic, a world in which there are two-sided platforms, where one platform is a very strong incumbent, a world in which there's no price competition, at least on one side of the platform. Think about Google or Facebook. We get their services allegedly for free. We pay with data, but basically at a zero price. A world where there are gigantic network externalities. I want to be on Facebook because my kids are on Facebook, and vice versa. In fact, vice versa, my kids don't want me on Facebook, but that's a different story. But anyway, there are network externalities, and there are important switching costs. And I know that the younger one of you might think that the switching costs are very small, but for people like me, learning a new digital platform, learning a new social media is always a cost, and I stick to the default. And we're going to see a test is how many people will switch out of Zoom after they become so comfortable with Zoom during this period. And so the paper has some theory and some empirical evidence. Before we go through the algebra of the model, let me give the intuition of the model, because I think the intuition is very simple and I think very powerful. So think about the following. In any acquisition you can think of, the price a new entrant can fetch depends upon two things. One is if you run an auction, the competition among bidders, and the value as a standalone alternative. Now think about a world in which there's only one large incumbent in your space, so you can't really rely on competition among bidders. Then what determines your valuation is really the standalone alternative. This is the value you will have if you are not acquired. Now, notice, and people who are familiar with a complete contract literature will see this very clearly, notice that even if in the world in which you never go alone, this outside option, this counterfactual, is very important in determining your valuation. Now, the important thing is that your alternative value, your standalone value, depends crucially on the number of eyeballs that you can attract. So if I am WhatsApp, my valuation that Facebook is paying for me depends very much on how many customers or many eyeballs I have now or I expect to have in the future. Now, so far, up to this point, there is nothing new. Now, introduce switching cost. Now, the decision of customers to adopt WhatsApp or not is a function of the expectations about the future. So if you are somebody like me, who is reluctant to go and move to a different technology, is going to wait on the sideline and decide to adopt only if I think this is really superior and a lot of other people have adopted. So in this decision, I incorporate the fact whether this is adopted or not. So suppose that I'm really a Facebook user. I'm not really a Facebook user, but suppose I am. WhatsApp came along. Am I willing to actually make the effort? If I know that WhatsApp is going to be acquired by the dominant platform in the social media space, which is Facebook, I know that they're going to do everything possible to make the two compatible. And so what is my incentive to try? Let me sit and wait until the acquisition takes place. And after that, I can proceed. So the expectation of being acquired depresses the number of customers, which depresses the valuation at which I can be acquired by Facebook. And of course, that depression leads to less investment ex ante. So the only thing that is new in the paper here is to bring together the customer side with the investment side and see the interaction between the two, okay? And so from now on, I'm gonna do the model, but if you understand this intuition, you can actually check your email for a while until, if you don't care about how we derive that, and go later to the empirical evidence. So the model is a very simple model. We have an incumbent platform that we call I, and a new entrant E. And without loss of generality, we assume that the quality of the incumbent is normalized to 0. And the quality of the new entrant is a parameter theta, which is taken from a uniform distribution between two bounds.
Now, Luigi, can I ask you a question?
Please.
Hi, this is Sabrina Howell from NYU. This is super interesting, and I just wanted to understand the intuition a little bit better. The sense I had of this notion of the kill zone was that large companies with huge amounts of cash acquire startups too early in their life cycle in order to generate the type of then makes it possible to generate the type of home run returns that VCs look for in what they either an IPO or what they call a competitive acquisition, which is roughly the size of an equivalent IPO that the company could have IPO'd but chose to get acquired anyway. That basically what the kill zone is buying WhatsApp when there were only 2 employees, right? Too early. And the alternative is that the company can demonstrate to customers that it has enough value added, it has a sufficiently better product to motivate them to switch, to pay the switching costs, which would be the standard route that would lead to a mature, successful company that can IPO. Is that not, are you thinking of a different kind of kill zone?
Yes, we are. And it says we thought about that possibility, but it's not obvious that that possibility is in any way suboptimal. Because if I buy new entrants early on, remember, there is a huge amount of uncertainty that an entrepreneur faces. So the fact that I buy early, unless you can tell the story that they know much better and so they underpay you, but they are going to provide some form of insurance. And so they're going to create more entry. So what we care about is not so much the impact on that particular entity that has been started, but the ripple effect on other new startups. So if I buy WhatsApp very early, and by the way, at a pretty hefty price, why that's not a super incentive for everybody else to actually start a new company? Because before, if I was a smart engineer, I would say, I know how to produce a better social media, but I don't know whether I will be able to market it. I don't know whether I will be able to raise enough money. I might be screwed by the venture capital along the way, blah, blah. So the fact that Facebook comes in and buy me early is actually, in my view, a strong incentive to produce more. So I don't know how that idea can lead to an inefficient kill zone. And that's the reason why we go to a different model. Okay, so going back to the model, there are 2 groups of customers. The way I like to think about it is my son and I. So my son is a computer scientist, so he's a techie. Those are in measure lambda, less than 1, so that's relatively small. And then there are the ordinary customers like me, and the size is normalized to 1. Okay. Now, the techie decision is that they are potentially early adopters. And so when a new platform comes in, they observe some signal of quality that is noisy, and they decide whether to switch to the new platform or not. And of course, they're going to do that when this is bigger than some switching cost. Okay. And we assume that there is some switching cost because they need to understand the platform and blah, blah, and this switching cost is uniform distributed. So if you want to get a sense of the timing, you have a entrant even before day 0, then at day 0, the techie see a signal of quality and decides whether to switch. Then at date 1, incumbent and entrant decide whether to merge or not. And then sort of customers will be using and then produce profits and so on and so forth. But all the action is between basically date 0 and date 1. And at date 1, the two companies have to decide whether to merge or not. And they share that of the improvement in value of the synergies of the mergers will be allocated, determining on the bargaining power. And an important feature is if they do merge, the superior technology will be adopted and will be enjoyed by all the customers, basically at no extra cost, because the new entity will make sure that everybody is fully compatible and doesn't pay any cost. It's a bit like, for those of us who are older, remember the time of the Microsoft Office being at the front line, is when Microsoft introduced Excel and PowerPoint, make sure that they were fully compatible with Windows and they wouldn't crash every other day like WordPerfect used to do. Now, later we know that was crashing because Microsoft was putting stuff in to make it crash, but that's a different story, okay? So if the two companies don't merge, then they will survive for a number of periods with parameterizers and continue, yeah. So there are the techies like my son, and there are the ordinary customers like me. They don't have sufficient information to switch. This is very autobiographical. So in the second period, they are confronted with a decision whether to switch or not, only if the merger fails to go through. So if the merger went through, I sort of never learned how to use WhatsApp before it was part of Facebook, and so I don't pay any cost. So my decision to switch is based on two things. Number one, my perception of the technical characteristic of the platform, but also the number of customers, techie or not, that the platform is able to attract. And so I need to form an expectation. So the ordinary customers do face some network externalities. Like me, I joined WhatsApp or Facebook just because to be with my kids or to be with other people. And so my benefit is a sum of the expected quality and a total measure of the customers, techie or not, that opted in. So at the beginning of period 2, people like me have two pieces of information. One is they observe how many techies switch in period 1, so that gives them an inference about the quality. And number 2, they observe a private signal of the quality, and is given by that. And for simplicity, we don't have any switching costs at this point. And also, again, for simplicity, we don't switch back. Once we go, we don't switch back. So the first part, and I will proceed rather fast here because I think I don't have that much time, but I want to give you the intuition of a consumer decision. And then I will appeal for people who are familiar. This is a standard Morris-Sheen global game. Once you set it up properly, the solution is pretty standard, so there's nothing new. But just to give you some feeling, the techie will decide to switch or not based on the benefit of switching, which is a function of Q, which is his perception of quality, and the number of other people that are going to be there, which is 1 plus M, where M, I made a mistake. So his value is the value of technology, Q, multiplied by the how long you're going to be in this new technology. You sort of are going to be for one period, which is the 1, and then the M is equal to 0 if the merger takes place, because then the two things are integrated, so you don't have any extra benefits. Or is equal to, sorry, I'm going too fast and I'm confusing myself. So Q is the value of the technology, the perception of the value of technology by the techie. And this is multiplied by the number of periods that you will enjoy this technology, for sure 1. And then the M stand is if you don't merge, then the differential benefit is you're going to get a superior technology for N period. So M is equal to N. On the other hand, if there is a merger, then everybody's going to enjoy the superior quality. So the differential benefit of having switched the first period is 0. So that's where the 1 plus M times Q bigger than S, which is the switching cost. And so you're going to have a rule decision. And this takes into consideration the fact that, and this is all the updating, that you observe what the techie have done. So you have a posterior that is based, as you can see, that raw is based on your signal, but also the signal that the techie got. That is what you infer from their behavior, okay? And I don't have time to go through all this detail, but the bottom line is that you're gonna have a switching game where the 1 only equilibrium, and the theorem is that the switching function has a unique switching equilibrium, and the optimal switching point decreases, and the fraction of ordinary customers switching to the new technology increases in the number of periods 1 plus M. So this is pretty straightforward. Why? Because the longer the period the firm will remain dependent, the more techies will switch to the entrant for a given signal they observe. Because as I show you in that inequality, longer M is good. The second is this will increase the network externality of the ordinary customers that are planning to join. And so will increase the number of ordinary customers that are planning to join. And this will enhance the expected value of the new entrant as a standalone entity. Okay, so that's really what this is about. Now, let's go to the merger game. We assume that mergers are efficient, and as a result, they will always take place unless they are prohibited. And the merger will generate as a benefit this total welfare function. What is this total welfare function? There are n potential people, and what you're going to have is a mass 1 plus lambda of people enjoy the superior technology, so 1 plus lambda times theta, plus there will be the network externality that people like me, the ordinary customers of mass 1, will enjoy if everybody switch. The mass is lambda plus 1, so lambda plus 1 times 1 is the benefit in terms of network externality, and the theta times lambda plus 1 is actually the benefit due to the superior technology. So that's the welfare. Now, what I want to do is, what is the payoff of merging? So if the merger takes place, we assume that there is a take it or leave it offer. And so if you are the entrant, you're going to get a weighted average of your standalone value and some of the surplus that you generate. So you always get your standalone value, plus you get a little bit of the surplus you generate. Now, in case the merger is prohibited, then the payoff is going to be just your standalone value. Now, there are complicated formula here, but what I want to point out is the WE is the welfare generated by the new entrant that we assume that is going to be able to extract, and so that's equal to profit. But this welfare of the entrant is when there is no merger, and the welfare of the entrant as a standalone when there is no merger is different. And you see is indexed one by PM, the other by PNM. And what is the difference? Of course, if I expect that no merger will take place, I am naturally gonna have more customers because people are more willing to switch. And so P is not the price here, sorry for the notation, P is the mass of people that switch. So the mass of people that switch, of ordinary customers that switch, is larger under the non-merger rule than under the merger rule. And as a result, what we derive, which is easy, is that the price that the entrant will get is larger. Okay, so the key result is that, and if the entrant's bargaining power is 0, which is not that unreasonable, we can discuss later, the payoff is clearly larger when the mergers are prohibited, even if this prohibition leads to firms not fully exploiting the network externality and the technological gain. So, of course, by continuity, this is true if the bargaining power is sufficiently small. And the idea is, if mergers are prohibited, the entrant will attract a greater customer base because people anticipate to be to anticipate that the two entities will be separated, and when the two entities will be separated, they have more incentive to switch because they want to go to the superior technology. Okay, so that's basically the key result of the model. Now, once you have that, it's a piece of cake to say, ex ante, if you are a potential entrant, you face some R&D cost, then you draw a technology, draw a quality based on some investment in technology, then you will invest if and only if your expected return is bigger than a certain amount, and prohibited acquisition might actually increase this expected return, and this increase, because this increase will make more viable more businesses, so you will have more investment. So the bottom line is that by having a prohibition, you might have more investment. Okay. Now, before you jump out of connection because of what I said, we're not advocating that you should prohibit all mergers. We're just trying to establish something that was not obvious to us ex ante. Is it possible that the venture capitalist Wenger or Elizabeth Warren were right in saying that mergers might deter new investments? Okay, and we show that under certain assumption, this is true in our model. Now, models are nice, and if you're smart enough, you can build any model you want. The question is it true in practice? So now we're going to try to give you a little bit of a flavor. I don't have a lot of time, a little bit of a flavor of the empirical work. Now, I want you to understand that the model, in no way the model say that you have to have a decrease in investment. So the model just proves a possibility theorem. And generally, we don't like possibility theorem because you say, so what? Now, we thought it was important to build it. Number one, because it's not an obvious possibility theorem. So, and seeing the reaction on Twitter to Elizabeth Warren's statement, I think a lot of people in the academic and especially law and economics community did not foresee that possibility existed. So I think proving the possibility theorem is useful. What is even more useful is to try to look at the data. Now, the ideal test is a test where you ban mergers and then you see what impact they have on innovation and investment. And I think that if Elizabeth Warren had been elected president, we might have had this experiment, but she wasn't. And so we need to resort to less than ideal experiments. I don't think they allowed us to use as a natural experiment the election of the president of the United States. So we need to look at something else. And what is the strategy? We look at mergers that do take place under the assumption that they could have been prohibited. And the fact that they are not signal that the FTC and the DOJ will let other similar acquisition go through. And so our idea is we look at this investment and we look at the impact on, we look at these acquisitions and we look at the impact on investment decision by related companies. So the idea is we identify which events are big enough to matter. We identify a set of treated firms, so firms that are similar enough to the one being acquired to be affected by that. And then we construct a cycle-adjusted measure of investment. And we do really an event study, compute this cycle-adjusted measure around the acquisition events, 3 years before and after, and then we aggregate these event studies across events to see whether there is some significant impact. So this is the list of acquisitions of at least $500 million done by Facebook and Google between 2006 and 2018. So we only have 9 of them, so that's what we have. Now, there is a big issue. All the model is expressed in terms of substitute. Some of these are real substitutes, some are complements. In the paper, you can find explanation why we think that this model can apply also to complement, but I'm happy to take more questions about this. Now, how do we define investment? We look at similar companies. What are similars? We use 2 measures. One is a measure of based on a description of the business. This is similar to the measure that Gordon Phillips built based on the description of the industry. But we also use a traditional measure, and we standardize it. So this is, for example, the blue line are what happened to companies after Facebook and Google acquire in that space. And you see that the investment is pretty flat, but the year after the acquisition goes down tremendously. The alternatives are other investment in the software industry at the time where you have an acquisition in that software industry, but a software industry that is not dominated by a digital platform. And so you see that after the acquisition is a pretty flat kind of curve. Now, that's a pretty picture. We do some more serious, given the limited amount of data we have, but more serious analysis, which is based on all these event studies, and we find that the post-acquisition dummy is significant and negative. So indeed, investments go down in similar companies when there is an acquisition. So that's consistent with the kill zone idea. And this result seems to be fairly robust to different measures of similarity, even if we stick to new startups that are not too similar to the existing one, even if we stick to new deals, and so on and so forth. So let me end by giving a little bit of implication. The first one is that what Wenger and Warren said is not blatantly inconsistent with theory, and the data suggests that it's even plausible. Now, this is interesting because it might negative effect innovation in some areas. Now, you can't really do serious analysis by comparing 2 countries, but it's suggestive, the fact that the place that develop a alternative set of digital platforms is the only place where our digital platform could not enter, and that's called China. The EU or India, where they are pretty big markets, you cannot claim they don't have enough engineers, yet you don't have alternative digital platforms. Why? Because in our interpretation, they were deterred by the existing platform. So that's a sample of 2 or 3, so it's not serious work, but I think that is important. Now, we establish a concern. We'd like also to have some recipe. I think it's less clear what you want to do. I think that in our model and in practice, prohibit all the mergers is not a good idea. Number one, because it prevents the industry from realizing ex post efficiency. So it's not a good idea. At least it's not a good idea as a blank statement. And then in practice, how do you define the boundaries of the prohibition? If you go to a case-by-case approach, this will inevitably lead to approving all acquisition, because ex post is always efficient to do an acquisition, what you want to do is prohibit it ex ante so that you create the right incentive ex ante. So I think that if there is one message we would like to leave you with is really, really important to reduce the switching cost. Not only externalities and network externalities play a big role here, switching costs play even a bigger role. If you have network externality with no switching cost, the problem will disappear. So the message here is the more you make system interoperable by even forcing incumbents to accept interoperability, the better you deal with this issue. And I will stop here.
Thank you very much, Luigi, for the great presentation. And if you from the audience have a question, please raise your hand. In the meantime, I have a couple of questions that came through the chat. The first one is from Rina Agarwal. Should it matter whether the acquired firm is owned by a PE firm or not?
Not in our model. That's completely irrelevant. In fact, the statement of venture capitalists suggests that they are the first one to be concerned. So the idea, at least the way it was conveyed to us by the venture capitalists, is I don't think I get enough of an upside by investing in this sector because of the acquisition by Facebook and Google. And that where we thought there was kind of an inconsistency with vis-a-vis at least the traditional IO literature, because an acquisition by Facebook and Google, especially at the prices that Facebook pay, seems to be a strong incentive. So how can very smart people like VCs be deterred? Are we missing something or are they missing something? We concluded maybe we were missing something.
Yeah, perfect. Second question, this comes from me. So your entire model kind of hinges on the idea that once the company gets acquired, you basically changes the nature of the app. But in many cases, acquisitions, they are de facto leaving the app as is. So for example, if you take, for example, WhatsApp has been acquired, but you haven't seen huge changes in the operability of the app itself. So how would you kind of change the model according to this, or do you think it's relevant or not?
No, it is very relevant. I think that in some cases, actually, people end up killing the alternative strategy in order to make it, to destroy the opportunities. In some cases, as you said, they keep it alive, but it's not obvious that they do all they could do alone. In a sense, it's true that WhatsApp is there, but it's also true that WhatsApp is not marketing as aggressively as they would if they were competing with Facebook. It's not true that they are taking away so many customers as they would. It's not true that they added all the features they could because they are under the control of Facebook. So I think that the fact that they keep it alive does not necessarily invalidate the model.
Mm-hmm. I see. Perfect. So the next question comes from Stefano Rossi. I'll unmute you, Stefano. You can talk now.
Hi, Luigi. So it seems to me, a very interesting model. It seems to me the main policy implication, I mean, besides switching cost, is that the antitrust rule should take into account potential future competition, that is the potential future customers of the entrant in the counterfactual world of no mergers, rather than the current size of the entrant, which of course Facebook and Google are able to bypass because they just acquire firms when they're small. Now, do you think this can be implemented? Does it, can a regulator make counterfactual reasoning? Should a regulator make counterfactual reasoning?
First of all, I think the regulators make counterfactual reasoning all the time, right? Because when they do a merger analysis, they have to compare what happens under the presumption of a merger with under the presumption of no merger. And at the moment, they're both counterfactual because you have not seen the merger. So you don't know the effect. So it's hypothetical, and they do it all the time. But also this idea of looking at the benefits of new entrant is not new. For those of us who are old enough to remember the Microsoft case, the Microsoft case was based, the antitrust case against Microsoft to be precise, was based exactly on this idea, was based of we are certainly making consumer better off. As a non-techie computer user, I was non-techie even as when I was a younger fellow, I was delighted that everything was integrated by Microsoft. It made my life much easier, okay? So there's clearly a consumer benefit on that dimension. However, the possibility of stuff like Google arising will be deterred if you knew that everything had to depend on the Windows platform, okay? And I remember actually assigning to my students as example of bad papers, the papers that was published in the GFE on the stock market effect of the antitrust enforcement against Microsoft. And what was showing, the paper what was showing is that the stock market was going up every time the antitrust case was weaker. And the paper was having a setback. And the paper was claiming that there was a welfare loss from antitrust. And this reason is wrong for two reasons. The obvious one that most students would get is total welfare and stock valuations are not the same thing, even if in finance we tend to ignore, but I think they're two different things. And antitrust is designed to some extent to reduce the market value in order to increase the consumer surplus. So that's not surprising. But more important, all the stocks that were traded at the time, that were in technology, they were dependent on Microsoft. And the antitrust decision was not going after those stocks, was going after the people in the garage that were trying to compete against Microsoft. They were not traded in the stock market. So that's what we care about. So the antitrust back then did take into consideration. I don't know why it cannot be taken into consideration now.
Perfect. So next question comes from Jin Liu, who's asking, how does the main result change if the entrant has considerable bargaining power?
I think it's, of course, it will weaken. The only case in which it completely disappear if you have all the bargaining power. If you can extract all the surplus, then it doesn't really matter, because your valuation as a standalone entity pays zero weight in the entire game. So short for that assumption, the model goes through. And I would say, I didn't have time to do in the presentation, but if you think about the bargaining taking place between Facebook and a startup, and we're not talking only about the acquisition of WhatsApp, etc., but look at acquisition or smaller acquisition. For very few people know of TNH. It was a small social media that was getting viral among younger people, was bought out by Facebook even before most people pay attention, at probably a valuation of 100 million, but we don't know because it was below a threshold. So that's the kind of things that they might be doing. At that stage, the bargaining power between TNH, there was a bunch of people in a garage, and Facebook is clearly unbalanced.
Perfect. Next question comes from Zun Liu. I'll unmute you, Zun.
Oh, hello. Thank you for that. I have a question. I was in the venture capital industry, and also we observe from the capital market is they would like to increase the investments before they go listed or being acquired, because the capital invested would be valued at a premium in the future when they are acquired, for example, using the PE ratio. So how your model would reconcile this, this kind of stylized effect we observed in the capital market? Thank you.
So I'm not disputing that on average, of course, there are incentives to invest in the venture capital industry. It would be a pretty silly model saying there are no investment in general. It's a counterfactual. You see a lot of people investing in VC. We're saying that a lot of acquisitions done by incumbent platforms might, on the margin, reduce the investment in certain industries. And And that's what the paper is about. It's very targeted to certain industry where we even do find some evidence of less investments than in similar situations.
Perfect. Next question comes from Charu Agarwal. Go ahead, Charu.
So we wonder how many Rossi and Agarwal there are in the queue.
Yeah, Charu, we cannot hear you. Are you there, Charu? Okay, then I'll mute you again, and we'll go to Betty instead. Give me a second. I've unmuted you. Betty, you can go ahead. Oh, just give me 1 second. Okay, you can go ahead, Betty.
Sure. Hi, Luigi. This is Betty Zing from University of Waterloo. I'm just wondering if we can draw any implications from the model regarding whether it's better for incumbents to acquire the startups, compare that to develop the same technology in-house, which seems to be an alternative if the mergers are banned. I'm just thinking that from the perspective, can we take this model a step further to infer anything about the decision for the incumbent whether to develop the technology in-house or to acquire from a startup, anticipating this ex ante underinvestment for the startups?
That's an excellent point. And then you have to think about a bit what is your welfare function, because what you're saying, which is definitely true, is that we will see even more investments. So what we document here is simply a decline of investments of other guys starting up. But in the counterfactual, if you had really a prohibition of merger, what you will see is Facebook and Google will invest even more in these technologies. And then from a welfare point of view, do you see this additional investment as completely wasteful, or do you see that as promoting faster and better technology? I tend to come down of the view that this is promoting faster and better technology, so that's welfare improving. But we can legitimately disagree on this point, and unless you build a model of return on investment and welfare implication, etc., you can't really draw a sharp conclusion on that front.
Thank you.
Perfect. The next question comes from, or comment comes from AJ. AJ, I'm muting you. Go ahead, you can talk.
Hi, Luigi. Intel and other such firms have their own investment arm. They act as VCs, and they are investing in a bunch of startups. Now, would you consider those firms to be ready for acquisition by Intel or by others, or how would they fit into the model?
Actually, you raise an interesting question, more for the data, in my view, actually for both, but more for the data than the model, because I need to double check. I'm not 100% sure, because the way we look at investments here is we look at venture capital funding. I should have specified venture capital funding to startups. And so to the extent Intel as an arm and this arm is a form of venture capital, etc., I think we capture this number very well. To the extent this is internal investment, so if Google funds internally the self-driving car, for example, I don't think we capture that. And if Intel is developing its own, well, think about Uber. Uber for a while was developing its own self-driving car. We will not be capturing this because this was internal investment. So that's from the data point of view. From the model point of view, I don't see the difference, because the beauty of this model, if there is one, is that does not depend in any way on any wealth or liquidity constraint. So, and we thought when we're trying to build the model, we thought about the possibility of going down that route. And certainly you can make a case that that matters, but that's not what we're doing. And so the fact you have deep pockets like Intel does not change any of the result of the model.
Okay, so I have the question from Charu. Actually, he wrote it in the chat. So he's asking, is it possible to get the same set of results when the entrant does not have superior technology, but by preventing early acquisition, it is able to negotiate better price at later stages merely because of the steady customer base?
That's an interesting question. So if a new entrant has an inferior technology, then depends how noisy the signal of the techies is, because the techie will not switch. Remember, the techies don't have any network externalities, so they're not going to switch to an inferior platform. The ordinary customers like me, when they see that no techies are there, they're probably likely not to switch as well. So I think it's very difficult for a inferior platform to get customers in our model.
Okay, perfect. Does anybody have further questions? If not, we are at a very natural stopping point. Let me thank Luigi for the great paper and presentation, and also thanks to the audience for being so active and keeping the seminar entertaining. I'd like to also thank Anna Kormis and Rin Agarwal for teaming up in this wonderful initiative. And please make sure you follow us on Twitter at GUFinPolicy. And I'd like to remind you that next week we have Antoinette Chouard as the next presenter. And thank you very much, everybody, for logging in. And thank you so much again, Luigi, for the great presentation.
My pleasure. Thank you for organizing this. And please stay safe, everybody.